Good morning, students. Today, I'll explain Book 2, Chapter 8, Accounting for Share Capital, Part 2, Class 12th, Accountancy. Now, classification of share capital from accounting point of view. So, from accounting point of view, share capital can be divided in three parts. This is authorized capital, issued capital, and subscribed capital. This capital is shown as per Schedule 3, Part 1 of Company Act 2013 under the Notes to Accounts for each class of share capital. Now, authorized capital. According to Company Act 2013, Section 2 of 8, authorized capital or nominal capital means such capital as it authorized by the memorandum of a company to be the maximum amount of share capital of a company. It is stated separately for each class or kind of share, that is preference share and equity share. So in simple word, authorized capital is also known as nominal capital or registered capital. It is the maximum capital of a company. No company can issue more than the authorized capital. And it includes two kinds of share, equity shares and the preference shares as well. Next is issued capital. According to Company Act 2013, Section 2 of 50, issued capital means such capital as the company issues from time to time for subscription. Issued capital is a part of authorized capital that is issued for subscription. It includes, besides shares issued for subscription, shares allotted for consideration other than cash, shares subscribed by the signatories to the memorandum of association. So in simple word, issued capital can be equal to authorized capital or less than this. Issued capital means the capital which is offered to the public for subscription. And it includes issue of share for cash, either it is equity share or preference share. Issue of share for considerations other than cash. And issue of share to the signatories to the memorandum of association. Next is subscribed capital. According to Company Act 2013, Section 2 of 86, subscribed capital means such part of capital which is for the time being subscribed by the member of a company. Subscribed capital is classified as subscribed and fully paid up, and subscribed but not fully paid up. So in simple words, subscribed capital means the shares taken up by the public. Subscribed capital can be equal to issued capital or less than this. Subscribed capital can be shown in notes to accounts in two forms: subscribed and fully paid up, and subscribed but not fully paid up. Now, what is the difference between the two? Subscribed and fully paid up means the company has called up the total face value of the share and the amount is received. Subscribed but not fully paid up has two situations. Company has called the total nominal value of the share, but the amount is not received. Or the company has not called the total nominal value of the share. Now, calls in arrear. It means the amount not received by the company. That means this is not paid by the shareholder against the amount called towards the share capital. It means the amount is called up by the company but not being paid by the shareholders. Calls in arrear is always shown under subscribed but not fully paid up in notes to accounts at the amount received by the company against those shares. Now, calls in advance. A company, if its article of association permits, may receive amount against calls not yet to be made. The amount so received is called calls in advance. In the notes to accounts, it is shown under the head of current liability and the subhead of other current liabilities. Now, reserve capital. Reserve capital is a part of subscribed capital that a company resolves by a special resolution, not to call except in the event of winding up of the company. Such shares are shown as subscribed but not fully paid up. Now, capital reserve. It is a reserve which is created out of capital profit and not free for distribution of dividend. It is mandatory to create capital reserve in case of capital profits earned by the company. And it is disclosed under the head of reserve and surplus. Now, what is the difference between the reserve capital and capital reserve? This difference can be shown on the basis of 5 differences: meaning, creation, optional or mandatory, resolution, writing off of capital losses, and disclosure. So first is the meaning. Reserve capital is the part of uncalled capital which cannot be called up except the event of winding up. Whereas capital reserve is the reserve which is not free for distribution of dividend. Now, creation. It is uncalled capital. Whereas capital reserve is reserve set aside out of capital profits. Third is optional or mandatory. Reserve capital is not mandatory to have reserve capital, but capital reserve is appropriate to transfer capital profits to capital reserve. Resolution. A special resolution is required for reserve capital, but no resolution is required for capital reserves. Now, writing of capital losses. It cannot be used to write off capital losses, but capital reserve can be used to write off capital losses. Now, disclosure in the balance sheet. Reserve capital is not disclosed in the company's balance sheet, but capital reserve is shown in the company's balance sheet under the head of shareholder fund and the subhead of reserve and surplus. Now, what is the difference between the authorized capital and the issued capital? This we can discuss on the basis of 3 situations. First is meaning, second is disclosure in memorandum of association, and third is whether one can exceed the other. Now, meaning. Authorized capital is the amount stated in the memorandum of association which a company can raise as share capital of the company, whereas issued capital is the nominal value of the part of authorized capital which is issued for subscription. Now, disclosure in the memorandum of association. Authorized capital is stated in memorandum of association, but issued capital is not stated in the memorandum of association. Next is whether one can exceed the other. Authorized capital is equal to or more than the issued capital, but issued capital is equal to or less than the authorized capital. Now, see the different situations with the help of the example. This is the example of subscribed capital which is fully paid up. In this example, students, you will see a company's authorized shares are 1 lakh, face value is 10 each. These are the equity share. So the value will become 10 lakh. Preference shares are 10,000 and the face value is 100 each. So the value will become 10 lakh. That means total authorized capital of the company is 20 lakh. Now, out of these 1 lakh equity share, company is issuing only 90,000 share at the rate of 10, which will become 9 lakh. And out of 10,000 preference share, all the 10,000 preference shares are issued by the company and the face value is 100. This will become 10 lakh. Total issued capital is 19 lakh. Now, all the 90,000 shares, issued shares are subscribed by the public and the amount is also paid at the rate of 10. This will become 9 lakh. But here company is issuing 10,000 preference share, but people are subscribing only 7,500 shares at the rate of 100 each. So only 7,500 will be shown. At the rate of 100 will become 7,50,000 and total will be 16,50,000. It is the situation when the full face value is paid by the shareholders. Now in the second example, we'll see a company is registered with 1,50,000 equity share of 10 each. That means authorized shares are 1 lakh and the authorized capital will become 15 lakh. 1,50,000 into 10. Company is issuing only 1 lakh share where the face value is 10. So issued capital will become 1 lakh share at the rate of 10. This is 10 lakh. So issued capital is 10 lakh. Now receive the amount on all the share except a final call of rupees 3 on 10,000 share. So students, you see here, company is having 1,50,000 shares. Out of that only 1 lakh shares are issued. All the rupees 10 is called up. All the money is received except on 10,000 share. So here we'll see out of 1 lakh shares, on 90,000 share rupees 10 is received and on 10,000 share only rupees 3 is received. So we'll keep them separately. First we'll take 90,000 share. 90,000 share face value is 10, called up is 10, paid up is also 10. So this will be shown separately under subscribed and fully paid up. And 10,000 share whereas face value is 10, called up is 10, but the paid up is only 7 because rupees 3 are not paid. So that means on 10,000 shares at the rate of 10, called up will become 1 lakh. 30,000 is the area which will be deducted and the rest 70,000 will be shown in the outer column and the total of subscribed capital will become 9,70,000. So this is the situation when the money's face value of the share is called up, but on 10,000 share total face value is not received. Now we'll see the another example. In this question also you will see the total authorized capital is 2 lakh share of rupees 10 each. So authorized capital will become 20 lakh. 2 lakh share into 10. Issued capital is 1,50,000 share. So issued capital will be 1,50,000 into 10, 15 lakh. On which it is yet to make a final call of rupees 2 per share. So students, please make it clear. Face value of the share is 10. Rupees 10 is not yet called. That means called up is only 8. So this will be shown under the head of subscribed but not fully paid up. Number of share are 1,50,000. Face value is 10. Called up is 8. This will become 12 lakh. On 10,000 share rupees 3 is not received. This will become 30,000 and in the outer column we'll write 11,70,000. So this way in the first example full amount was called up and paid up also. In the second example, full amount was called but not paid up. In the third example, full amount is not called up. So this way you will show them in the subscribed capital in two categories, subscribed and fully paid up, and second is subscribed but not fully paid up. So this way this share capital will be shown in notes to accounts. So it is a format of your company's balance sheet. This we have already done earlier. It is a balance sheet as per Company Act 2013, Part 1, Schedule 3, where we have two sides, equities and liabilities. Equity and liability has four heads and asset has two subheads. They have all these heads have this subhead also and the item also, and it is to be learned by all of you in detail very carefully. Here is the example: disclosure of share capital in the balance sheet. So students, in the balance sheet, under the side of equity and liability or the part of equity and liability, shareholder fund is written first and then share capital. In the notes of accounts you will write 1 and the amount of share capital will be written in the amount column. And other different kind of capitals are shown in the notes to account. Here we'll write subhead. In the balance sheet we write head and subhead. In notes to account we write subhead and the items. So in the share capital, first we'll write authorized capital and will be closed. Then we'll write issued capital, this will also be closed. Then we'll be write subscribed capital, first subscribed and fully paid up and then subscribed but not fully paid up. Subscribed and fully paid up in the outer column, subscribed but not fully paid up in the inner column first, then calls in area will be deducted. If any amount of share forfeiture is there, that will also be added and then will be written in the outer column. And the total of subscribed capital is shown in the balance sheet. So this way share capital is shown in the balance sheet. So students, you will revise the concept from the notes. You will learn the balance sheet with its major heads, subheads, sub-subheads and the items. And you will try question number 1 to 4 from the exercise T.S. Grewal, page 8, number 1, 8.113. Thank you so much.